Part 1. The Promise. Everyone makes it sound boring. Buy an index fund, hold it forever, don't touch it, retire rich. You've heard it 100 times, from the finance guys on YouTube, from the Reddit threads, from that one coworker who won't stop talking about his Vanguard account. And part of you believes it, because the logic is clean. You buy a tiny piece of every major company in America. They grow, you grow, time does the rest. So you open an account, and that's when the questions start. Part 2. What you're actually buying. You're 24. You just opened your first brokerage account. You have $200 to invest and absolutely no idea what you're doing. You type S&P 500 into the search bar. 17 results come up. VOO, SPY, IVV, FXAIX. They all seem to track the same thing. You have no idea which one to pick or why it matters. So you spend 3 hours reading about expense ratios, and you learn that the difference between a 0.03% fee and a 0.20% fee on a $10,000 investment is about $17 a year. You pick VOO because someone on Reddit said it was good, and you buy one share. You've just become an index fund investor. Here's what that actually means. An index fund is not a stock. It's a basket. When you buy VOO, you're buying a tiny fractional ownership of 500 companies. Apple, Microsoft, Amazon, Google, Berkshire Hathaway, and 495 others. When those companies collectively grow, your investment grows. When they collectively fall, your investment falls. So you don't pick the winners, you own all of them. And that's the entire strategy. It sounds too simple to work. That's why most people don't trust it. And that's exactly why it does work. Part 3. What nobody tells you about the first year. Your first year investing in index funds is going to test you in ways you didn't expect. Not because the strategy is complicated, but because your emotions are. Month 1, your investment goes up 3%. You feel like a genius. You tell a friend. You check the app twice a day. Month 3, the market drops 8% in 2 weeks. Your $200 suddenly becomes $184. You feel sick. You check the app 6 times a day. You read articles about whether a recession is coming. You wonder if you should sell and wait for things to stabilize. You don't sell, but you want to. Month 7, the market recovers. You're back to even, then slightly up. You stop checking the app every day. You start to understand something important. The market is not a straight line. It never has been. It never will. It goes up and down and sideways, and then up again in a pattern that feels random in the short term and inevitable in the long term. The S&P 500 has had negative years, 8 of them in the last 40 years. But in those same 40 years, it has returned an average of roughly 11 to 12% annually. Every single crash, every single recession, every single time someone said this time is different, it still recovered. It went higher, it always has. What nobody tells you about the first year is that the strategy is the easy part. The hard part is doing nothing when every instinct tells you to do something. Part 4. The math they don't show you. Here's where index fund investing stops being boring and starts being one of the most powerful wealth building tools available to regular people. You're 25. You invest $500 a month into an S&P 500 index fund. You don't touch it. You don't try to time the market. You don't move it when things get scary. You just contribute every single month for 30 years. At an average annual return of 10%, the historical average, here's what happens. After 10 years, you've contributed $60,000 of your own money. Your account is worth $102,000. After 20 years, you've contributed $120,000. Your account is now worth $382,000. After 30 years, you've contributed $180,000. Your account is worth just over $1 million. You've turned $180,000 into $1 million. Not by picking the right stock, not by timing the market, not by doing anything except showing up every month and not panicking. But here's what the simple math doesn't show you. It assumes you never increase your contributions. It assumes a perfectly smooth 10% return every year, which never actually happens. And it assumes you never touch the money. The last one is the hardest part. Part 5. The fees nobody talks about. Index funds are cheap. That's one of their biggest advantages over actively managed funds. But cheap is not the same as free. And the difference between a low-fee fund and a slightly higher-fee fund is not as small as it looks. Here's what that means in real numbers. Two investors, same $500 a month, same 30-year timeline, same 10% gross return before fees. Investor 1 uses a fund with a 0.03% expense ratio, like VU or FXAIX. After 30 years, their account is worth $1,013,000. Investor number 2 uses a fund with a 1% expense ratio, like many actively managed mutual funds their employer defaulted them into without explaining the difference. After 30 years, their account is worth $784,000. Same contributions, same market returns, same timeline, $229,000 difference, because of a fee most people never noticed. Check every account you have right now, your 401k especially. Look at the expense ratios on the funds you're in. If any of them are above 0.5%, find out if there's a lower cost alternative and switch. That one action could be worth hundreds of thousands of dollars over your investing lifetime. Part 6. When the market crashes. At some point in your investing life, probably more than once, the market is going to drop significantly. Not 8%, not 12%. We're talking 30, 40, 50%. It's going to feel like the end of the world. The news will say it's the end of the world. People around you will be panicking. Some of them will sell everything, and everything in your body will tell you to do the same. Here's what actually happened to someone who invested $10,000 in an S&P 500 index fund in January of 2007, right before the 2008 financial crisis, which wiped out nearly half the market. By March of 2009, their $10,000 was worth about $5,400. They watched $4,600 disappear over 14 months. If they sold in March 2009, they locked in a 46% loss. If they did nothing, if they just held, by 2013, their investment was back to $10K. By 2020, it was worth $32,000. By 2024, it was worth over $60,000. The people who sold in 2009 lost half their money. The people who did nothing turned $10,000 into $60,000. Same investment, same fund, completely different outcome based entirely on one decision made during the worst possible moment. The crash is not the danger. Your reaction to the crash is the danger. Part 7. The account types nobody explains. Here's something most people figure out too late. Where you hold your index funds matters almost as much as which index funds you hold. There are 3 main account types and most people only use one of them. The first is a regular brokerage account. No tax advantages. You invest after-tax dollars, you pay taxes on dividends every year, and you pay capital gains taxes when you sell. It's fine, but it's the least efficient option. The second is a traditional 401k or IRA. You invest pre-tax dollars, meaning every dollar you contribute reduces your taxable income right now. Your money grows tax deferred. You pay taxes when you withdraw in retirement. If your employer offers a 401k match, you contribute at least enough to get the full match before doing anything else. That match is an instant 50 to 100% return on your money. Nothing else comes close. The third is a Roth IRA. You invest after-tax dollars now, but your money grows completely tax-free. When you retire and withdraw, you pay 0 taxes on everything, including the growth. If you're in your 20s, this is one of the most powerful accounts available to you because the decades of tax-free compounding are extraordinary. The order of operations most financial advisors agree on is employer 401k match first, Roth IRA second, max out your 401k third, and then a taxable brokerage account last. Most people skip straight to the brokerage account because it's the easiest to open, and they leave decades of tax advantages sitting on the table. Part 8. The boring truth. Here's the part nobody wants to hear. Index fund investing is not exciting. There is no moment of triumph. No stock you picked at the bottom that went to the moon. No story to tell at a dinner party. You just contribute every month, You don't check it constantly. You don't react to headlines. You don't try to get clever. You don't stop when things get scary. You just keep going. And that consistency, that almost boring, almost mechanical consistency, is exactly why it works. Because the average investor dramatically underperforms the market, not because they picked the wrong funds, but because they got in and out at the wrong times. They bought high because everything felt good, and they sold low because everything felt terrifying. The index fund doesn't do that. It just holds everything, all the time, through everything. And over long enough time periods, it beats the vast majority of professional fund managers who spend their entire careers trying to do better. Not sometimes, consistently. Study after study shows that over 15 to 20 year periods, more than 90% of actively managed funds underperform the S&P 500 index. The boring strategy beats the smart strategy almost every time. Here's the truth about index fund investing. It's not complicated. It's not exciting. It doesn't make for a good story. You pick a low-cost fund, you set up automatic contributions, you leave it alone, you do that for decades. And somewhere along the way, quietly, without fanfare, without a single exciting moment, you become wealthy. Not because you are smarter than everybody else. Not because you timed anything perfectly. Not because you got lucky. Because you were consistent when most people weren't. Because you held when most people sold. Because you trusted a 70-year track record when the headlines were telling you not to. The market will crash again, probably multiple times during your investing lifetime. And every time it does, the boring strategy will look like the wrong strategy. It won't be. It never is. The only question is whether you can be boring enough for long enough to find out.